I'm going to skip that question and move on. How many people in the room have come across qualified money? How many in the room have seen qualified money inside of an annuity? Okay. What I'm going to talk about here is something that is kind of built out in three parts. What I like to do is look at opportunities that not only present a chance for us to reach out and market something new and differentiate ourselves from all the competition. There's a million insurance advisors in the country. You've got to stand out one way or another. But I like to then package that in with products that address the issue as best they can, especially in a low interest rate environment, and even tie in some life insurance. And as the annuity director, I sometimes hesitate to admit this, but I would rather sell life insurance than annuities. At the end of the day, I think it's pretty obvious what the benefits are. But we come across diversification needs, and we come across a lot of money in annuities, and it's a heck of a market. So what I like to do is always try to see if I can combine the two products as well and create more opportunity for our clients. So I'm going to stage this out in three parts. I don't use a PowerPoint, but I do use a couple of reference tools, and they're in a PDF, and we're going to throw them up on the screen as I go. But if for any reason you can't see it, which is most likely, we'll have some handouts and some materials that we can email you guys, and you can reference this stuff later. But really what I want you to capture is kind of what's going on. So first, you know, I always talk about, and the guys that work with me, they know that I'm all about the analogies and the metaphors, but I always throw out that I like to find out that the house is on fire, and then I then like to find the bucket of water, and we like to show you how to put the fire out. So let's talk about the fire first. In 2006, there was a major change to the way that required minimum distributions are calculated or supposed to be calculated with regard to money inside of an annuity. And I was shocked to find out that a lot of CPAs and tax advisors weren't even aware of this. Now, typically when the IRS changed the code, they write these really long, elaborate regulations, and they put them out there, but nobody rings a bell or sets off an alarm. It's kind of up for you to find this stuff out. And insurance companies, they always kind of take a step back, and for those insurance carrier reps in the room, forgive me for this, but you take a step back and say, hey, we're not tax advisors, so figure it out on your own. And that kind of leaves a problem for us. We're always out there trying to figure things out on our own. And so hopefully what I can show you here is a problem that may be new to you that you haven't learned about yet, and also is something that you can really attack the market with. I think this is something that you could put flyers out on, you could put mailers out on, you could really do a lot to promote the opportunity to talk to more clients about their qualified accounts. So who's familiar with how a required minimum distribution is calculated out of an annuity? What do we look for? Let's talk about the annuity specifically. What do we look for when we get our clients get their statement at the end of the year? We look for what? The contract value, right? So we would take that contract value, and we go online and we find the cool calculator tool or the irs.gov website, and we plug that contract value into a calculator, and it gives us a percentage payout that our clients are supposed to take for that year. And we do that every single year for our clients. So as we get new statements, the end of the year, a contract value goes into the machine, and out comes a payment that we're supposed to make. And these percentages increase every year after age 70 and a half. So everybody with me? Everybody, that's pretty general. We all get that stuff? So in 2006, the IRS said, well, wait a minute. If this money is sitting inside of an annuity, and this annuity provides additional benefits, and I don't know if we can pull that up on the screen right now, Mike. I've summarized in one page what 600 pages of a reg talks about. So I'm trying to break this down as easy as I can. But what they did is they said, you know what, RMDs are going to have to be based on an entire interest. Not just a contract value, but they call it the entire interest. And any annuity contract after 2006 that has an additional benefit has to create a new value for you to calculate these RMDs off of. Okay? And by additional benefit, we read on through these regs and we find out, well, wait a minute, they're talking about income riders, death benefit riders, and minimum contract value guarantees. Well, what does every single annuity contract, variable or fixed, have today? It's those three. And we're selling the heck out of this stuff because in a low interest rate environment, that's one of the best features that you can put on a product. And they're really good features. And so what I'm going to talk about today is not to discourage you from selling these products because these are great products, but it's to make you aware of what's really going on. So let's look at entire interest. Entire interest consists of that contract value that we're all familiar with. So our clients are going to get a statement and they're going to have a contract value. And they're going to add that to an actuarial present value of the additional benefit inside this contract. And boy, is that a mouthful. So let's look at this for a second. If I've got an indexed annuity, I've got an account value, and I've got my GIA, VIA, VGAAB, DWMB, whatever it is. We got an income rider or a death benefit guarantee. And I might have $1 in my account value, but I might have $2 in my income account value, okay? So what they're saying is that the insurance company, not you, not the CPA, the insurance company has to assign an actuarial present value to this $2. They have to say that $2 in real money, in today's dollars and cents, we're going to make some actuarial assumptions as the regs tell them to do, and we're going to say this $2 is worth 50 cents. Okay? So I've got to then calculate my RMD based on this dollar plus this 50 cents. So now I've got $1.50 I've got to take that RMD percentage out of. So everybody with me so far? Okay? So the insurance company is responsible for giving us this number so we can add it to this number to come up with this number in order to put into the calculator and tell us what our clients' distributions are going to be. Well, here's the fire. Okay? Here's the problem. There's 2 insurance companies that I found that actually know about this and are actually doing something about it. Every other insurance company is expecting your client to know what's going on. Pick up the phone and call them at the end of the year and go, can you tell me what my actuarial present value is? Is that going to happen? Of course not. And their CPA doesn't know anything about this either, so no one's telling them, hey, wait a minute, you might be taking the wrong number out. You might not be taking enough of these distributions, and there could be some penalties involved with that. So there's a serious problem in the market today. Insurance companies aren't doing their job in getting the actuarial present value communicated to your client. They're not telling them what the entire interest number is. So that's an amazing opportunity for you to go in the home, or you to put some ads out there, or do some emailing, and say, there have been some major changes to the distribution rules on your qualified money. Have you purchased an annuity for your qualified money since 2006? If the answer is yes, you better call me today. What's going to happen? Phone's going to ring. I can say I had the best CD buster rate in the world, and I'll get some action on the mailer. I'll get some action on the advertising. But if I talk about taxes and a major problem and some major changes, my phone's going to ring even more. So the opportunity is immense to go out there and say, hey, look, there's a little something you should know. And you know what the killer part about this is? It really isn't even happening yet on the index annuities. It's on the variable products out there because they had the riders first. And they've had long enough to cook that now our clients in these RMDs right now, they're starting to have to take these distributions and they're getting the calculations completely wrong. So there's some caveats, like there always are. If you want to go back on the screen there and show this one pager, and I don't know if anybody can read this, forgive me if you can't, there's an exception. There's always an exception to the rule. The exception to the rule is if the benefit hasn't exceeded 120% and it's reducing pro rata and it offers a return of premium and the stars and the moon and the sun line up, then this doesn't your client doesn't have to take the entire interest. How fast on these riders do you get to 120% of original principal? Real fast. In 10 years, they all double. So if our clients are deferring and then triggering the income rider, or they're deferring and they've got a death benefit guarantee and they're taking out distributions, they're probably getting the wrong number. So again, we've got a major issue here. So let's step back a second. How do we address RMDs in the first place when we're talking about annuities? There's a few good products out there that have these death benefit guarantees, and we show our clients how they can put money into a contract, and with the rider's capability of providing a high compounded interest rate, we're able to preserve principal for a longer period of time than we can in most other assets while giving them the downside protection and the other benefits of the annuity. So we got to thinking, we're going, okay, well, we got a major problem. RMDs are probably going to be higher than what we think for our clients. So some of the products we've been using aren't going to cut it because 4% guarantees, they're not going to cut it if I'm having to take out 6 to 9% in my 80s in terms of what my RMD is going to be. So we went out there and we started searching the surface of the sun here in Arizona, and we were looking for all the products out there that offer these death benefit guarantees and these income rider guarantees, and we found one in particular that has the absolute highest guarantee for death benefit for your client. So now we can address the problem. We can say, hey, look, the house is on fire, and I happen to have the bucket of water. And the bucket of water is going to be in the form of a product called Forethought Bonus Advantage. This is a relatively new product that has hit the market, and actually, if you haven't heard about it already, it's definitely something that you want to take a look at. And it's not even a product that specifically is great for this. It's great for a lot of different reasons. But today I'm going to specifically hone in on 2 key components in this contract that address this issue. Our clients are going to have to take out more money with these contracts, so we need to get them the highest guaranteed rate of return for not just their income, but for their death benefit. Financial planners talk about a lot of different things in terms of theory and how they want to distribute or ladder people's assets in order to be efficient for taxes for income. And 9 times out of 10, the theory all relates to taking your non-qualified money first and pushing that qualified money towards the end. Because 1 or 2 things are going to happen. We're either going to try to get you into life insurance if we can to try to cover that asset, but we're going to push that off to the end because you're going to need that money at some point later on, especially with life expectancy being longer and everything. We're going to still want access to this money in terms of a pool that we can take for income. But we push qualified money off towards the back. And maybe if you're lucky, your tax bracket might be a little bit lower in your older ages, so you might not have to pay as much ordinary income tax on a qualified distribution. So we push that money towards the back. But what we're inevitably doing in that planning strategy is we're pushing them into required minimum distributions. And a lot of times when our clients hit age 70 and a half, there's enough non-qualified assets to still provide them a stream of income into their earlier mid-70s, and they're thinking that qualified money, I'm going to use that more in my 80s. But the IRS forces you to take it. So even though we have to take these distributions out every year, how do we overcome it? And if you can go back to the illustration we had earlier, not this one, the one prior. Almost. There you go. So we're being forced to take these RMDs, and a lot of times we don't want them. So I'm going to do an example here. I'm going to walk through an illustration. This is really cool because this illustration software, it actually allows you to pre-calculate required minimum distributions, put a single premium dump into the contract, and show how you can have over 100% of principal left after 10 years of taking RMDs out. Okay? I'm going to walk through this example real quick. We put $1 million in it, and I used $1 million because it's easy math and it looks really good on an illustration. Likely you're not going to come across too many $1 million IRAs or qualified plans, but they're out there. But let's think about this. So I put $1 million in this contract. In the course of 10 years, that first big red circle, we show that we took out over $355,000 in required minimum distributions. Okay? Over 35% of the contract depleted. And if we take another step over to the second red circle, look at what that death benefit value is at the bottom. Can everybody see that? It's $1.1 million, over $1.1 million of death benefit left over. So I started with $1 million, I took out $355,000, and I've got $1.1 million left for death benefit. And if I keep going to my life expectancy, let's call life expectancy, according to Steve, as a male, I use a 70-year-old male here, we're going to die probably at age 81, but let's just assume age 85. If I go to age 85, I've taken out a ton of income, required minimum distributions, and I still have a massive death benefit left over. So if we go to the very far column on this, what does that tell us? Well, it tells us that I've put $1 million in this contract, and I take all these distributions, nearly $1 million of distributions out of $1 million deposit, I still have about $600,000 of death benefit left over. I've taken $1.55 million of benefit out of this contract in the combination of income and death. There's no other contract on the planet that can do this. This is the only one, and here's why. They offer you a 6% compounded death benefit guarantee along with a 6% income guarantee, okay? So we all know how these riders work. You get this phantom interest of 6%. They charge you once for the rider, but the rider gives you both the death benefit and the income guarantee. And then they also let this contract grow up to 250% of original principal. So what's the average? Anybody sell Aviva? Aviva's a real popular company. We sell them too. They go up to 200%. Anybody sell North American? They just discontinued their death benefit rider. There's not a lot of options out there for us anymore, and this one offers us a 250% growth or 6% compounded up until age 85, whichever happens first. That's phenomenal. And with that 6% compounded interest, we're able to overcome these massive required minimum distributions that we have to take out. We're forced to do it. We don't want to, but we're able to overcome that. So this is the only contract you're going to come across that can maximize the potential of not just income, but death benefit. And here's something else that's kind of cool about this contract. Remember I was saying we push this planning strategy, we push this qualified money off the back end because we want to use it later. Well, what's going to happen here in the next 10, 15 years? Healthcare costs are going to go through the roof, aren't they? They already are. They're going to get worse. They're not going to get any better. Okay?
3 times in the next 10 years, you're saying, like
Triple in the next 10 years. Dan, I owe you $5 for that comment. Triple in the next 10 years. Okay? What happens when you print off trillions of dollars? Everybody remember the late 70s, early 80s? Inflation. It's inevitable. It has to happen. Now, Bernanke, thank you for promising us that in 2014, that's when we maybe will start ticking it up. But I guarantee you in 10 to 15 years, inflation is going to be off the charts. So we're going to need this income at some point, most likely. And how many people also go into the home and they talk about their clients' income goals and they're like this big, but they have this much money to work with? So you can't really get there. This product, if you defer for 10 years, it pays you guaranteed 8%. We talk about these payout factors. This payout factor is 8% after 10 years of deferral, guaranteed until the contract runs out of cash. You're guaranteed 5 years if I got a 0 on the index. You're going to get a lot more if I get any rate of return at all. So what I'm able to do is show my client with this illustration that I can help them take these RMDs that they probably don't want quite yet. I can preserve principal for death benefit. And when they turn 80 and they're probably going to have some more healthcare costs, they're going to have this inflation, they're going to have to deal with this income issue, I'm going to pay them $96,000, almost $100,000 a year, 9.6% of your original principal, guaranteed for 5 years. Why is that important? How long does it take for you to get through your own money with an income rider before you get into this phantom guarantee? Anybody know what the statistic is? 12 to 15 years. It takes you 12 to 15 years in all these scenarios to get through your money in an income rider so that you finally get into these phantom guarantees. So you better live a while for it to really be a benefit, right? With this forethought contract, if you defer for 10 years, you're guaranteed over 77% of your original principal in 5 years. By year 10, you're into their money. It's a game of beat the insurance company. I want that interest rate that I've been paying for. It's costing me almost $1 a year, right? 1% a year average cost for these riders. I'm paying for it. I want my money. I want my guarantees. So this is one of the only contracts in the country that'll do that. So I can say, hey, client, I can show you how to take all your RMDs out. We can cover that. We can preserve principal because you want to transfer as much as you can off to your beneficiary. I can also accelerate your income and feed you over $1 million well before life expectancy if you started with $1 million, and we're going to start getting into the insurance company's money. And if you do live to age 90 or 95, the benefit out of this annuity is going to far exceed anything else that you can do on a worst case scenario. I'm not even talking about 2% or hypothetical. Forget the index. Let's wipe the index part right off that illustration. I'm assuming 0. Worst case scenario, this thing kills every product in the country when it comes to the strategy that I'm talking about. Okay? That's pretty powerful stuff. So let's rewind a second. I've got a major problem. The house is on fire. RMD calculations are different. Did you know about it? Give me a call because it's going to affect you. You might not be taking enough money. Oh, you bought an annuity already? You got a contract? Great. Do you have the one that's the best in the country? Because I've got the one that's the best in the country. It gives you a 6% guarantee. It accelerates your income. It's going to preserve your principal. After 10 years, you're going to be more than whole. Well, Eric, what do I do with those RMDs in the first 10 years I don't want them? Oh, I love that question. I love that. Here's the life insurance story. Let's flip to the next illustration. So inevitably, I got $1.1 million in a qualified account. I'll get right to you here, and I'll summarize this part, and then I'll grab your question. I got $1.1 million of death benefit left over here after I've taken these RMDs out, right? But it's still a qualified plan. It's still qualified money. What happens if I die? What happens to the $1.1 million? I pass it on to my spouse. She wants to use the money. It's taxed. Okay? You can't pass it on without passing on that ordinary income tax exposure, because at some point someone's going to take constructive receipt of this qualified money and they have to pay taxes on it. So that's why we buy life insurance. And what I did is I took a current assumption, or excuse me, a guaranteed universal life contract, and I'm giving a little bit of a plug here to Mutual of Omaha, but there's a handful of GULs in the country that will not only give you a 121 guarantee, but they build cash value. Now, I could probably buy way more death benefit if I went to the absolute best GUL out there, but what I'm doing is I'm trying to be a little bit more conservative, and I'm trying to think about my client having problems with health care or additional needs, or if you live in Arizona and your air conditioner blows up, which happens, that's $12,000. And if you're 76 or 86, that air conditioner means a lot. We hear about it all the time here in Arizona. People are dying from not having their air conditioner work. So wouldn't it be nice to create an additional pool of money that they can even loan to themselves tax-free to have some emergency cash. So what I did is I dumped just 10 years worth of these RMDs. I'm assuming my client needs the income at age 80. So I just took the first 10 years from age 70 to age 80 and I dumped it into a life insurance contract and I bought over $562,000 of tax-free death benefit. Now, in my lifetime probably, but some lifetimes maybe not, I don't know if we're going to really reach 56% ordinary income tax, but it's possible, right? So I've covered my client for up to 56% of their original principal in terms of taxation. So if I died at age 80 and I had a $1.1 million benefit that I passed on to my spouse, she's also going to get $562,000 of tax-free death benefit to help cover those taxes and maybe some estate taxes. It depends on how you set up your planning. So we're really trying to do multiple things for our clients, but it all starts with the problem. How do we market? How do we get more clients, more qualified money? We tell them there's a major problem. And then we address the problem with a really great annuity. And then if we have the right health class, and I assumed here a standard on a male at 70, so it's not preferred plus, it's standard. It's relatively average for a 70-year-old, blood pressure pills, what have you. So I took a standard and I dumped that money in and I showed them the third leg of the race. I said, we've got you covered on the RMD. I'm going to help you preserve principal. Let me throw some money in this contract for you now and show you how I can cover the tax issue too. And it's a three-part process. So the house is on fire, I got the bucket of water, and oh, by the way, after the fact, we're going to help you rebuild. We're going to help you paint the walls again and rebuild, and that's where the life insurance comes in. And I've got, if you look there at the end, at age 8, I got over $200,000 of cash value in a GUL guaranteed to age 121, and I only paid 10 premiums into it. So this is a phenomenal concept. I encourage you to look at this for your clients. If you come across qualified money, talk to them about these illustrations, and then call us here at Brokers Alliance. Our life internals and our annuity internals work together. They know how to produce these illustrations for you, so we'll customize this stuff. This illustration that I showed you from Fourth Audit, it actually comes into a 7-page illustration, fully customized for you and your client. It's a pretty neat point of sales piece. And this part's easy. In that Word document I showed you earlier, there's 2 links. One's to the irs.gov, and if you want to read those regs, go for it. I use them to get to sleep at night. There's another attachment that you're going to get, and it's the Society of Actuaries summarize that. They went from 4 billion pages to about 400,000. So they did a pretty good job summarizing. And then I put all that into 1 page, and it's a Q&A. Take that 1 page out and go into your clients and do a Q&A session with them. What does it mean that I have to take this entire interest? What does this mean? Why are the insurance companies doing this to me? Why is the IRS doing this to me? And it's a 1-pager. It's an easy explanation. And then you move into the product sale. So again, we're trying to do more than just be a business card stapled to a policy in a shoebox in a closet. We're trying to be on a first-name basis. We're trying to put plans in place so that nobody can come in behind you and change things. Because your client's going to go, whoa, 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 I got a plan here. This guy's got me covered. He talked to me about RMDs. I've got life insurance. My advisor took care of me. My advisor's name is Joe. My advisor's name is Dan. Okay, you're not some anonymous person that just sold 1 policy. So start thinking this way, and if you don't already, I encourage you again, think about life insurance too in combination with an annuity sale. By the way, if I sold this particular client, I think the commission's something like $96,000. So hey, not a bad payday either. So now that I did the best thing I could for my client and I made $96,000 bucks, it's not bad. Questions?